A very good afternoon to everyone. As we all know that annual report is a comprehensive document that an organization publishes at the end of each financial year. Annual report provides stakeholders with a detailed overview of company's financial performance, achievements, challenges, and future plans. It gives a holistic picture of company's activities and outlook. So with this, I would like to welcome all the participants in today's webinar on navigating excellence, examining the DNA of outstanding annual reports. Uh, we have amongst the presence of our eminent speakers who are a great source of knowledge, CA Ankit Maheshwari sir and CA Kuldeep Kothari sir. CA Ankit Maheshwari is a highly accomplished and dynamic chartered accountant with an exceptional track record of over 15 years of professional experience spanning various geographies. With a strong focus on financial reporting framework of large listed companies in India, Ankit sir has established himself as an expert in assurance. CA Kuldeep Kothari sir is fellow member of the Institute of Chartered Accountants of India, FR framework and ESG reporting and advisory, direct and indirect tax litigation, investment and startup consulting. He is the author of various books and has delivered lecture on topics like FRF, income tax, GST, investor awareness, and personal finance. Now, I would like to request CA Kuldeep Kothari sir and CA Ankit Maheshwari sir to start with the today's session.
Thank
Thank you,
you,
Rahul.
Rahul, for a very warm introduction. And this session comes in light of the previous session only,
Mm,
where post session we were receiving a lot of queries over, various aspects, which because of the paucity of time, we were not able to deliberate. The idea is to, again look into both these sessions are related sessions. So somebody who has
mm,
attended the previous one will be able to link it more. However, we have tried to
mm.
make changes. So let me first place my thanks to Rahul and Neha for organizing this for us. Thank you for taking so much of pain in such a short duration, back-to-back sessions and everything. My sincere thanks to all the participants from corporate and from the auditor side who have come and wants to are very keen about learning the DNAs of an outstanding annual report. I have my co-speaker CA Kuldeep Kothari with me. He's an exceptional person in terms of financial side of the annual report. You'll get a lot of perspectives. He digs out deep into each and every note, each and every policy. The interpretations of India's, the interpretations of NFRA's advisory institutes guidance note. So you'll get, you'll get a lot of deeper perspective on the financial side today. And at the end, I want to place my thanks to the chairman of the research committee, CA Dr. Anuj Goyal. He was expected to join at 12. Somehow, I think he's stuck in a meeting, and we expect him to deliberate in between of the session. And we would always want to, hear from his side what is all institute is able to do in terms of, elevating the practices of annual reporting. My thanks to the vice chairman of the committee, Srinivas Kothaji, who is also instrumental in bringing a lot of changes, specifically in terms of the financial reporting the IC awards for excellence in financial reporting. But not last, not but the least, our secretary to the committee, Dr. Amit Kumar Agarwal ji, who is always keen about making sure that we are able to constantly come between you and deliberate on whatever the best practices are. There's a lot of change which is driving through the checklist at the international level, at the domestic level, and Neha has been flawlessly, uh, taking care of most minutest things. So entire the research committee, uh, all resources, my sincere thanks. I'll straight away come from where we left last time, and also for the new joinees, don't worry.
Mm.
Every aspect is a new aspect. Every note is a new note. Every section of the annual report is a new annual report. But naturally, last time we had a long deliberation on integrated reporting practices. How it should stand out in terms of IRC framework. What should be the reporting boundaries? How do we present a value creation model? All these things were deliberated. So if time permits today, we'll come back on it again. but the idea is to start from the financial side of it, and depict a outstanding DNA of an excellent accounting policy, or I would say today in today's era, a material accounting policy with its relevant schedule, what is going right, what is going wrong. So all these things will be there, and we will be very happy in case we receive a lot of queries from your side. So my request is that once the session gets over and you start posting the queries over the mails, over the LinkedIn's or to Neha, it's better that you ask it right now, because I am really not sure that whether we will be again able to come and deliberate over it. And next time when we meet, probably the reporting season gets over, or any change in the annual report becomes very difficult, because for all the listed companies here who are preparing their annual reports, I know how difficult it is to get an accounting policy change done. You have to put it to the audit committee, get those approvals done, then you have to put it to the auditors, then come back. So all these things are extremely important, and uh, are time consuming. So my point is that whatever today we deliberate maybe is would be a final deliberation from our side on an excellent reporting practice. Rest, then you can always put up your questions over emails. We'll try to answer it. Over to Kuldeep ji for a quick chit chat, and then we go ahead.
Sure. Thank you, Ankit ji, for this wonderful introduction of, I think, all of us. Before starting with the topic of the session or the prelude to what we will discuss in the session, I would like to place my sincere thanks towards the research committee, Honorable Chairman Anuj sir, Vice Chairman Kothas Srinivas ji, our Secretary Dr. Amit Agrawal ji, Neha, and the whole team, Rahul, specifically. So you must be wondering why we have kept the topic of the session as DNAs of outstanding annual reports. Let's examine or navigate the excellence. As you all are aware, a few years back, our Honorable Prime Minister said that we are the financial doctors. So उन्होंने कहा था हम अर्थ के डॉक्टर हैं. So this thought comes from that particular thing that our Honorable Prime Minister has said, and why to limit ourselves to the financial side only? Though we will discuss majorly on the financial side, but in the last session, Ankit ji has deliberated at length on the non-financial side or the integrated reporting part of the annual report. So let's be the financial doctors that the nation wants us to be, and let's examine with us the DNA of the outstanding annual reports, and let's be an important part. Why to limit us to the financial section or to the preparation of notes to accounts or whatever it is? Let's be the one who will be the torchbearer, the leading person will be looking after the preparation of the annual reports. So over to you, Ankit. Without wasting much time, let's come on the topic so that we don't miss out on many things which
this time we
the
won't.
audience.
This time we won't. This time we won't. This time it is well designed. Only thing is when you say financial doctors, so I think something to learn from doctors. The excellent doctors are somebody who are meticulous about their surgeries, their procedures, what they take. As chartered accountants, as auditors of these organizations, as somebody who is heading these organizations, as a CFO, as a head of corporate reporting, I think one common mistake I would say is the complacency while we prepare this report. And this complacency comes because reason number one, maybe dependencies on the big auditors. So you have big names of the auditors, and sometimes you feel that they can't go wrong. How bigger the doctor is, he still can go wrong, or
Yes,
so not only the big names, or maybe any bigger audit firm will have better procedures, better checklist. You are in that notion that we are benchmarking to model financial statement of a big four, or you might be in a notion that it comes from a very senior advisory from a partner of a big four, and that is why we don't have to take care. It is your accounts. I want to reiterate this fact that this entire preparation is responsibility of the management. An auditor is somebody to certify it. So nowadays, when NFRAs issue advisories, they not only issue to the auditors of these companies, they also issue to the management of these companies.
Management of the companies.
And they take a representation based on that. So it's a request that it's something which has to, if you have to crack the DNA of these outstanding annual reports, something which we should try to do is to be very meticulous about it and not depend on any external consultants, external agencies. You have to do it yourself, interpret it yourself, and then present it. The other top reason of these average practices is that a past precedent is there.
Hmm.
So somebody who is having a past precedent and he thinks that it's just about changing the numbers and rest remains the same. So we have to customize these things to the current transactions which a company is undergoing. So,
Hmm.
so that practice of keeping the previous annual report and taking it forward, that's something which is required to be changed. The third thing is a peer practice. So sometimes Neha, when I and Kuldeep ji are deliberating over this, so say if it is a FMCG company, they say the other FMCG is also doing the same.
Hmm.
That doesn't give us a liberty. So make sure that don't look at other people's annual report only. Look what law has to say on a particular matter. I think we will get a lot of clarity and we will be able to come out with strengthened thoughts. Oh, so I'll straight start sharing the presentation and we move ahead where we left last time. I hope my screen is visible.
Yes, it is visible.
Okay. So Kuldeep ji, I'll start away from the financial side this time, right?
Hmm.
And we had a long deliberation about wrong nomenclatures. Last time I gave you one example. Today I give you another example of a wrong nomenclatures. These are big companies, and that's what we were deliberating it last time also. Please go through your annual reports. As from the beginning only, I was saying that we have to be very meticulous about what we are writing and what this law wants us to write. And any wrong nomenclature doesn't comes. Maybe it will not have extreme consequence of a NFRA advisory or something like that. But from an excellent reporting perspective, if a wrong nomenclature comes, I think we lose a lot of ground uh, for the remaining annual report. How good your rest part of the annual report is, that will not, that will not be counted. All these mistakes are something which carries a huge weightage while deduction of marks. So this will not add up to something, add up to your score, but this will majorly reduce your score from institute's perspective. So I'll take the next note, and I want Kuldeep ji to rather deliberate on it because that's something it's interesting. Kuldeep ji, before you deliberate on it at a length, what is wrong in this note? I want because maximum companies present this note
That way
usually
only.
that the assets held for sale. Also, Kuldeep ji, today I want to discuss when you look at the format which Ministry of Corporate Affairs have issued of Schedule 3, and when you look at the financials of the company, uh, on the balance sheet item, you see a specific heading called assets held for sale. However, the format doesn't prescribe you to mention it on the face of the balance sheet. And lot of companies auditors are also not agreeing to change this. How because it's a that's what I told you. It's a past practice. But when you look at the Schedule 3 format, it is extremely clear that asset held for sale is not on the face of the balance sheet. And similarly, I pick one more example with this is the right of use of asset. So ROUs as per Schedule 3 are not expected to be on face of balance sheet. But when you go on 116, right, when you go on lease, so in lease, it is specifically said that it should come as a part of the schedule for ROU, where just below the property, plant and equipment, right, note that somewhere an ROU needs to be depicted. So my first thing is let's what's wrong in this entire schedule. That's where Kuldeep will deliberate at length with you. But before that, we need an answer. What do you think is wrong? Well, let's try to figure out. Second, as a caution, I am telling you when you are disclosing it on the face of the balance sheet,
Hmm.
So you have to look at the materiality of this item also, and also look at the compliance of Schedule 3.
Hmm.
So from institute's perspective, it is coming on face of your financials. You know, this might lead to a problem which says that the companies are not complying to the as it is format what Schedule 3 prescribes. Second is optional. I am saying we will deliberate this again that to what spirit we should comply to Schedule 3 format.
Hmm.
But first, you have to answer this. What is wrong with this schedule? And Rahul, you have to help us digging these answers.
Sure, sir. Sir, no answer received as of now.
I think we should wait for 10-20 seconds at least.
Right,
There may be
right.
a
There
time
is a
there.
lag. There is a lag.
There is a lag. Hmm.
Also, I put up another question. What are your thoughts whether ROU or asset held for sale should come on the face of balance sheet or should be part of the annexures? Rahul, any answers? What is wrong with this note?
Not yet, sir. No answer.
You can answer this on behalf of the participants, Rahul, if you wish to.
Rahul has drafted this entire note, right? When we had this
Hmm.
compendium issued, right?
Hmm.
So obviously, Rahul can obviously answer. Okay, do you think this note is correct? Yes or no? Simple answer. What is wrong? Let's leave it. That's something which we should answer, right?
Hmm.
Otherwise, it will not be justifiable for the audience, you know. But what is it? Is it a correct note?
Somebody has answered currency amount is not mentioned.
Okay, so one thing, the currency amount was mentioned uh, at the top of the this entire page that rupees are mentioned in crores. So your point is correct, right? But I am saying from technical point of view, right? What is wrong? I liked it that people are participating and we want maximum participation. That's how
Hmm.
we see. We all come from one fraternity, right? It's
Hmm.
just that anybody can stand up and talk about all these things tomorrow. Somebody who is prepared for it. So we'll be happy to
Sir,
know, Rahul.
Rinku Agarwal has said it should be part of the annexure.
Okay, so that's the answer to the second question.
Hmm.
And Rinku, you are very right. But when you look at the financials of top companies, pick any listed company which has asset held for sale, and they are showing it on the face of the balance sheet. I agree to Rinku, Kuldeep ji. The
There
spirit
are
of
few.
Schedule 3 has to be complied,
Hmm.
right?
Hmm.
And
Hmm.
if it is and some maybe the year in which you have kept these asset for held for sale, at that time auditor might have come to and have classified it thinking a material transaction to come on the face of the balance sheet, but nowhere in any Ind AS, nowhere in any Schedule 3 you are expected to mention it on the face of the financials. So that's over. Any other answer, Rahul?
Sir, Ankit Kamlesh has given the answer. Segment to which held for sale belongs should be disclosed.
Interesting answer, Kuldeep ji.
Hmm.
And
Very, very thoughtfully written.
Thoughtfully
Okay,
answer.
so now I am opening this, Kuldeep ji.
sir, one more
Tell
answer.
us. Okay,
There
Rahul,
are
please.
few more
Uh,
answers, I guess.
Few more answers, yes, sir. Sir, Praful Mitra has given the answer. Yes, this note is correct in my view. And
Okay, Praful.
Swaminathan has given the answer. AHS and ROU should be part of annexures.
Correct,
And
correct.
Ajay Kumar Tiwari has given the answer. Zero should not be shown.
Okay, Okay, another question comes up, Kuldeep ji.
Hmm.
Uh,
Hmm.
I will open this up now more, and we're not
Hmm.
taking any more answers, but I like the quantum of participation.
Hmm. Hmm. Hmm.
So some person said, I think Prafulji said that, it's a correct note, and apparently it
Hmm.
appears to be correct, right?
Hmm.
The problem will be deliberated by Kuldeep, but I
Hmm.
want to tell about zero. So zero has two
Hmm.
perspectives.
Hmm.
When you round it off to a crore, right? Who put this point zero?
Hmm.
Ajay Kumar Tiwari.
Ajay ji, when you round this off, to crores, so there might be some figure in lakhs, and that is why this is coming out to be zero. So
Hmm.
it can't be ignored. But your critical question is
Hmm.
whether the blanks should come or not, right?
Hmm.
If there is no nothing, and not only in respect to this note, in respect
Hmm.
of any note. Yesterday
Hmm.
only I and Kuldeep were discussing with a
Hmm.
company who
Hmm.
were disclosing their employee benefits, and they did not
Hmm.
had a particular class of employee benefit, but in India permits you to do that, right? So whether
Hmm.
it should come as a blank or not. So when it is a disclosure requirement of an index, then we suggest even if it is a blank number, you put it, right?
Hmm.
Because index expects you to uh, expects the user of the financial statement to know whether there is any amount into this particular aspect or not. But finally, zeros can come because of round off or because of a mandate of index. But if there was a previous transaction and it is still not, it is no longer in your books, no point putting up a zero.
Hmm.
So that's where an excellent reporting practice begins from. Now, Kuldeep ji, opening this for you, and I am very excited to hear what's wrong in this
Hmm.
note. You have put this to me to put up
Uh,
at the front of the presentation. I am keen. What is wrong? Even to me, it appeared to be correct.
I think in disguise you have already answered to the questions that you have asked. But since you have, entrusted this responsibility on me, let me take it forward. So first of all, I'll answer to your first question. It was regarding the way of presentation of particular class of transaction on the face of balance sheet. So when you were discussing, there were few more answers in which I'm just taking those answers just to correlate it to the discussion that we are going to have.
Correct, correct, correct. Yeah.
Mr. Ankit Gadia has said that, sir, India's 1 para 54 says it is to be shown on the face of balance sheet. And one other answer was that from Ankit Kumar Agarwal again, they are Ankit and Ankit everywhere, I guess. So he has said that assets held for sale shall be separately disclosed either in the face of balance sheet or in the notes to accounts. So Ankit ji, there are two things when we present our financial statement. From where we benchmark the format, I think it should be Schedule 3 only. And Schedule 3, it should be the guidance note issued by the Institute of Chartered Accountants of India. When we say that we benchmark model financial statement of any Big Four or any other organization, I'm not taking anyone's name. But I think, as you always say, and I always appreciate one thing what you have said to me in last to last session, that let's benchmark the law. So the law is what the regulator says, and the law is what is given in the Schedule 3. So if you talk from the perspective of Schedule 3, there is no requirement as such that it should be shown on the face of balance sheet. Now, correlating it to what Ankit Gadia has said, that it is there in the para 54 of Index 1, para 54, if I am not wrong, it says that there is certain information which is required to be given in balance sheet. If I am not wrong, it is that only. So uh, the concept of materiality has to be taken care of. So if you see a 12 crore rupee figure in a balance sheet of 10,000 crores or 5,000 crores is nothing material. In that case, according to me, I agree with the other part of the answer that it has to be shown separately in the notes to accounts. So an asset held for sale is part of, if say the non-current assets group, then you can subcategorize into the particular notes to accounts of non-current assets, and you can present it separately. Now coming on the question that whether it is required to be shown on the face of the balance sheet. So, in my opinion, if it is something which is material to the organization, like in the case of discontinuing operation, on any spin-off of any say a division of the business. For example, if you have heard about Borosil Limited, so few years back they have demerged their renewable energy business into Borosil Renewables Limited, and this year they have demerged the scientific wear business from the main entity. So in that situation, until unless it takes place, they will classify the particular class of assets into assets held for sale or asset on account of discontinuing operation. So in that case, if it is material to the entity, it is required to be shown on the face of balance sheet. Otherwise, in my opinion, whatever we have learned from Schedule 3 or the guidance note that we have gone through, it is not required to be shown on the face of balance sheet. When you read Ind AS 1, you can't just read a single para. You need to go through the para 117 also, which talks about fertility, and you need to go through Ind AS 8 also. So clubbing all these paragraphs or all these Indian accounting standards, one need to identify what is required to be disclosed on the face of balance sheet or not. But when you see, ICAI is the main regulator who is regulating chartered accountants. So if you talk about format, I think you should refer or benchmark Schedule 3. So I think comprehensively, I have tried to cover the first query what Ankit ji has posed. Anything else, Ankit ji, you want to mention to it, or
Just one thing. Ankit had a very valid point, and similarly, for that is why this I put up this question purposefully. With ROU also, when we talk about leased assets, so Ind AS 116 says that it has to be on the part of the fixed assets, which you are disclosing it as a part of your PPE schedule, or the balance sheet, right? Or as a balance sheet item, and a lot of companies disclose their ROUs on the face of the balance sheet. But when Ind AS gives me that option, right? So why not only to benchmark Schedule 3? That's my point. So if Ind AS mandates me, then obviously the Schedule 3 will be accordingly amended, and you will be put this information, because Schedule 3 has undergone so many amendments, right? And this has never come up that asset held for sale has to be a part. The idea is it has to be disclosed, and that's the bottom line of it. Now the second portion, Kuldeep ji, we can take this forward.
One more thing, Ankit ji, when you see that there is a contradiction between what Schedule 3 says and what Ind AS says, mandates says, then I think in terms of format or the way of presentation of particular line items on the face of balance sheet or profit and loss account, I think we should go by Schedule 3 only. And when there is a difference difference of interpretation or contradiction between the way of treatment that is to be done for recognition, measurement, disclosure, or presentation of any specific transaction, then I think that you should refer this specific Ind AS which is governing the particular. I'll give you a very interesting example. You and me are deliberating on the topic since last year that the key managerial remuneration, the remuneration to KMPs is to be shown in a separate way, and it is a requirement of para 17 of Ind AS 24. And very interesting fact, when you go through the Schedule 3, this is something new which I have discovered few days back only. You will see that it is written that if anything is paid to execute non-executive directors or independent directors, it is not required to be shown under employee benefit expenses. So when you see what is governing the specific disclosure requirements of employee benefits, then there will be Ind AS 19, and for related party disclosure, it will be Ind AS 24. So I cannot say, or I cannot take excuse that it is written in Ind AS Schedule 3 that it is to be shown under other expenses. I'll show it under other expenses. There is no employer-employee relationship, because there is a specific guidance mandate coming out of particularly Ind AS and ITFG that you very often speak
that has
about.
been delivered. Right.
Yes. So it is something very interesting that if there is anything contradictory given in Schedule 3, what is to be seen and how it is to be interpreted. So I think in terms of format per se, you go by Schedule 3, and in terms of specific presentation or disclosure requirement, you go by specific Ind AS. So now coming on the second question, what is wrong in this note? I think everything is wrong in this note. When you see the requirements of 105, it is, I think you will see 95% of the companies presenting it in the wrong way. I bet that 95% of the companies are presenting it in the same way or in the wrong way. What is wrong in this note? There are two specific requirements of an 105. When we classify any asset to be disclosed or to be identified as held for sale, when the transaction of selling that asset is anticipated to be materialized in the next 12 months. Am I right, Ankit ji, Rahul?
Correct. Absolutely correct.
This is the basic criteria. So what is wrong in this note? You see from where it starts, they have reproduced the language or the conditions of given conditions specified in the Ind AS. So there are two type of disclosures which are required, I think, almost in every Ind AS. One is qualitative and other is quantitative disclosure. So when you talk about qualitative disclosure, the reason for which you have classified any particular asset held for sale has to be given. So I cannot, blindly write that we have decided to sell it in next 12 months and we are classifying or disclosing it under asset held for sale. So for example, you have, you have classified any building as held for sale. There might be any reason that it is not of use for the company. The building is lying at a location which is the location or plant which is not in functioning as of now, or in case of discontinuing operation, or in case of any other specific purpose, you need to write down the qualitative information in this note. This is error number one in this note. Error number two is you will see stagnant or same figures in both years. 2 crores in 22, 2 crores in 23, 10 crores in 22, and 11 crores in 22, and 10 crores in 23. So what is wrong in this? When you see it is written on the face of note only, the sale has been agreed or is expected to be concluded within 12 months of balance sheet date. So what does it mean? It means that you are anticipating and you are sure that the sale transaction or the disposal transaction is going to take place in the next 12 months from the date on which you have classified it as held for sale. In case if you are not able to do so, or there is any exceptional situation which is not in the hands of company, so then in that case you need to specify the reasons why it is not the sale is not taken place. What are the conditions due to which it is still lying in the same manner it was in the last year, and specific conditions to paragraph B54 of 105 is required to be complied with. So in nutshell, when you see a note assets held for sale, it is not that for perpetuity or infinite period you can classify anything as held for sale and you need not to come on the same again. It
Give a
may be a
reason.
case. It may be a case that it will remain in the same manner it is as of now on March 23 for next 4 or 5 years. So it is not the intent of Ind AS. So the two errors, one is in the qualitative disclosure and second is in the quantitative disclosure, which is here. So over to you, Ankit ji, if you want to make a point. Otherwise, we'll
Nothing.
move on
I
to
think nothing. I think you deliberated it very well, right?
the.
So okay, Kuldeep ji. Now we come on, the hot burning topic of
Uh,
provision matrix, the
provision
disclosure of
matrix.
provision matrix.
Hmm. Hmm.
Mistake number one, the first mistake, the first reporting error. Till 80% of the listed companies in this country are not able to disclose a provision matrix with respect to the loss allowance or the impairment loss they are booking
Hmm. Hmm.
uh, for a particular year. Rather, there are 3-4 set of problems, Kuldeep ji. One,
Hmm.
that company, while writing these policies of trade receivables,
Hmm.
they claim that they are using a simplified approach methodology.
Hmm.
Thus, they are not expected to calculate a loss allowance.
Hmm.
So I think a simplified approach doesn't exempt you to not check the credit risk associated with it, rather gives you an option to calculate a loss allowance based on expected credit loss methodology.
Agreed.
So to all the companies, and that is why NFRA came up with an advisory on last 31st March as to whether trade receivables, how do you show it and how do you calculate a loss allowance, right? And that is well deliberated in last all session. So I don't want to come on it. How do you disclose a trade receivable? I think we are mature enough now after 1.5 years of that advisory that we know how to disclose a trade receivable. My point is the writing the policy of it. One. Point number two, where do you place this? So sometimes this is in placement of the trade receivable note, just below the trade receivable note, and the reconciliation or the movement of loss allowances also placed there, right? So this is this from where it should be placed. This is my question number one. When you put up a provision matrix, where do you place it in your annual report? We are expecting an answer over it. One, this is unambiguous. This has to be disclosed. So there is no confusion about it. So one, let's gear up for disclosing a provision matrix. We are all doing our calculations with respect to trade receivables, and we will also discuss the expected credit loss for the other financial asset in the next slide. My question is, Rahul, where do we disclose a provision matrix in an annual report? The problem is majority of the companies are disclosing it below the trade receivable note. So is it signifying your trade receivables or something else? And then we talk, Kuldeep ji, once we get an answer to this, then I want to know what is wrong in this provision matrix. And then I would want our learned, attendees to know what is a best practice, because NFRA is constantly reproducing it in their every advisory which they are issuing it. This is something which is, which is deliberated across all corporates, all corporate reporting teams. So my question, where do we place a provision matrix? Any
Sir,
answers to this, Rahul?
Before you take the answers, I'll add one more question, whether it is a provision matrix or not. That is something
Okay.
I think we want to hear from you.
Okay. So first, the placement. Any answers to this, Rahul? Where do we place a provision matrix?
Not yet, sir.
Okay, whether a provision matrix is expected to be disclosed in accordance with Ind AS 109. I hope the answer to this is yes, because if the answer to this is no, then there is no point deliberating it further. So Ind AS 109 mandates you to disclose a provision matrix. The policy has to be written in alignment to what the trade receivable policy has to be written in alignment to what provision matrix we are creating. And there are two compliances which we need to do. One, disclose the provision matrix. Two, disclose the movement in the impairment allowance. Any answers, Kuldeep ji? Where do we disclose a provision matrix in an annual report?
No answers yet.
Okay, let's take it forward then. And by the time we receive an answer, because I know lot of corporate reporting team don't deliberate on this. So maybe they might not know the nitty-gritties. But one thing I can tell you that this should not be placed below the trade receivable note. Instead, it is a measurement of your credit risk and should be in compliance to disclosure of your credit risk arising from trade receivables. And below this, you will find the calculations of expected credit losses for your
Hmm.
other financial assets. That's how a provision matrix appears to be. Now,
Hmm.
whether this is majority of the companies fail to disclose it. Rahul, do we have any answers now?
Yes, sir. Yes, sir.
Few
Praful
answers.
Mitra has given the answer. Provision matrix should be given along with the notes. Next answer is by the Jitendra Jain. It should be placed under FRM note as credit risk para.
Correct,
Next is
correct, correct.
from next is from Abhishek Jain under credit risk note.
I think so. One, I'm happy that we are on the same page. Two, Kuldeep ji, whether it is a provision matrix or not, you put up a very good question, right? So it appears to be a provision matrix, right?
Hmm.
But eventually, what it fails to disclose, so this company has done nothing wrong. Primarily, I'll tell you, they have disclosed what their methodology is
Hmm.
while calculating, and that is their actual methodology because we had a discussion about it. So I am now very confident about it. But it is unable to disclose the loss percentages. When I say loss percentages, the intent of the law is that if your trade receivables are 100 and 80 of the trade receivables are the outstanding are rupees 80 for less than 90 days, then in that particular case, for that 80 rupees, what is the loss percentage company should expect? And that is why it is the ECL method.
Hmm.
That's what an expected credit loss method is, a lifetime
Hmm.
expected credit loss method is. And this keeps on changing. So somebody should be able to track this loss percentage.
Hmm.
And that is why it is, it cannot be deemed to be a provision matrix. We have to disclose that out of 80 rupees, say your impairment allowance is 4 rupees, right?
Hmm.
So what is your loss percentage? Your loss percentage is 5%. So a user of the financial statement should know that in your 90 days receivable, the loss percentage is 5. From 90 to 180 days, it is, say, maybe you have 10 rupees outstanding and 5 of them are not paying. So the loss percentage is increased from 5 to 50%. I hope that's clear. If there's any confusion, and there might be a case that more than 180 days, your loss percentage is 100%. So a user of financial statement should know that a provision is calculated prudently based on the aging of the trade receivables, just the way this company is disclosing. So you can see this. Now I think whatever I said, Kuldeep ji,
Hmm.
any attendee would be able to understand. And the previous company was a 10 times larger company than this company is, right?
Hmm.
But it's
Hmm.
about the disclosure methodology which
Hmm.
comes. So
Hmm.
my point here is you can clearly see that this company is able to give this comparison that
Hmm.
last time within the credit period my loss percentage was 0.3, right? 7.77 percentage was my loss amount, 7.77, right?
Hmm.
uh, and which is now 1.21. So company is so sorry, vice versa. So now there is that the trade receivables are not having the recoveries of these trade receivables can be tracked from previous year to this year, and then the reconciliation of amount. So whatever we have written down should come, and whatever we have written back is very important.
Hmm.
Another mistake, Kuldeep ji, that people
Hmm.
write this net off.
Hmm.
So whatever you have written and whatever so this is a net of amount. Where is the written back amount?
Hmm.
So that is another issue which
Hmm.
is coming out. But as an excellent reporting practice on uh, ECL methodology on calculation of loss allowance, I think this is something which we can standardly benchmark. Again, I show another table. So I think Kuldeep ji, anything you want to add this up, or any questions we have on provision matrix?
I think there are a few responses. If Rahul, if you can help us with that, and then I would like to add one small thing to this.
Okay.
Surya Teja is given, and it should be presented under general notes, fair value measurement note. Gayatri has given the answer below the receivables with cross referencing. Ankit Kamlesh Gadia has given the answer in the notes to accounts under credit risk.
Correct.
Kishore has said it is not a provision matrix, it is an assessment of expected credit loss for financial assets.
Correct. Absolutely correct. Kishore is spot on. It's the methodology.
And Aarti has asked the question, in case of an lending entity, if the lender acquires or repossesses an asset from the borrower in settlement of claim receivable from the customer, where the same should be disclosed in financial statement and accounting of such assets will follow which Ind AS?
So when Aarti, my question to you is whether you are an NBFC or a banking company. So by the time Aarti answers it, Kuldeep ji, you were making up a point.
Mhm. Can you come on to the initial slide that you were showing? Yes. So I think the point you wanted to make was you see the policy which they have written, the provision matrix is prepared based on historically observed default rates over the expected life of trade receivables. So the important thing is to mention, as you have said, the default rate over the period of time. The default
Correct.
rate may change if the trade receivables is in the bracket of like 0 to 6 months or 6 months to 1 year, or if they are in the bracket of 1 to 2 years or 2 to 3 years, whatever it is. So a provision matrix, the essence of a provision matrix is the default rate or the ECL percentage which we have calculated. It may vary significantly, or it may not vary significantly on year-to-year basis. But yes, the point which I was trying to make has already been made by I think Mr. Kishore. It is not a provision matrix in my opinion. It is an assessment of expected credit loss and the methodology which the company is following. So in that case also, if you see, if you are writing the methodology, then you should not, I think, in my opinion, claim that it is a provision matrix. That is what I was willing to make. So you can, take it forward on the next slide.
Okay. Then we have another issue, right, coming up is the loss allowance which we are calculating, and a lot of companies are not disclosing this ECL methodology. It's an excellent practice to disclose your loss allowance for various class of assets, be it the other financial assets, be it your security deposits. Rather, Kuldeep ji, when NFRA gave an advisory with respect to PSP projects, so whether a loss allowance is expected to be made of fixed deposits and banks also, we already had a long deliberation. I would not want to open this up today, but all other financial assets, your loss allowance and probability of default needs to come up, even if you are holding a bank account with State Bank of India. That has been, I think, clarified n number of times. Still, we do not find provision matrix, or still we do not find the calculations of ECLs for other financial assets. Okay, now I move on the other thing, right? So since we are discussing the financial instrument best practice, right? So Kuldeep ji, now I'll pose up a different question. So what do you think is the best practice here? Why we are saying it is as a best practice? And did we had any answer from Aarti?
Yes, sir. NBFC. She has mentioned NBFC.
Okay. I'll pick this up. Let's conclude this and then we get back on Aarti's question. Aarti, I'll come back on it. What is, as of now, my question is, what is the best practice, right, here on this note? And how your financial instrument note is different from this note? There are two best practices arising out of it. Rahul, do we have any answer? What is the best practice here?
Not yet, sir.
Okay. Kuldeep ji, any answers to this?
No answers yet. Should I
So-
answer it for the audience?
Yes,
or-
yes. Yes, yes. We have to go ahead. We have to go ahead.
Your first question was, what is the best practice out of this note? Am I right?
Yes.
So, अंकित जी, राहुल, when you see, अंकित जी को तो क्या बताएंगे, उनको तो पता ही है, अपने लिए है. तो when you see that particular disclosure, it is coming out of the requirements of 107 and 109, if I'm not wrong.
Correct.
Read with 113, because wherever you are talking about financial instrument 107 or 109, fair value hierarchy or fair value is something which goes along with it. So it is like relationship of Vikram Betal. जहाँ विक्रम व बेताल होगा, वैसे ही जहाँ 107 और 9 है, वहाँ 113 का रेफरेंस आएगा ही आएगा. So when you see the disclosure requirements of financial assets and financial liabilities, so it is broadly categorized into three parts: fair value through P&L, fair value through OCA, and at amortized cost, based on the kind of asset or based on the business model that we are having for a particular asset or particular class of asset. So when you read the standard, there are certain financial assets and financial liabilities which are mandatorily required to be shown or measured at fair value through P&L. So in case of in the other case, we have an option to designate it or to measure it at FP through P&L OCI, or in the other case they are mandatorily required to be shown under fair value through P&L. So basically the Ind AS, I think para 8 of 107, that with 109, it requires you to clearly identify, bifurcate, and disclose it in the notes to accounts, that what are the financial assets and liabilities which were designated as to be measured at FP through P&L on initial recognition or subsequent remeasurement, or what are the class of assets which were mandatorily required to be shown under the head of financial asset through P&L or OCA. So I think, Ankit ji, we were deliberating yesterday also. I think the all sort of equity instruments or mutual funds or publicly market traded securities will come under mandatory disclosure, that they are required to be shown under FP through P&L, because there is nothing, we need not to check level 1, 2, or 3 for the fair value hierarchy. And other sort of assets, like if there is any unlisted investment per se, it can come into the designated part. Or if I'm holding any asset on the basis of HTM, sorry, held for sale, held for sale, or held for trading, or held for investment. If I want to, my intent is to earn the interest or dividend out of it, and then at the end of maturity, I want to sell it, then it is to be shown, I think, under amortized cost, and on the other side, it is to be shown under FP through P&L. So over to you for
One
concluding.
note I am reading. I have an annual report of a conglomerate FMCG, right? Of a FMCG. And because I don't want to present the name of the company, as I feel it's a grave mistake. So they have designated this other financial assets and liabilities. And the note is cash and cash equivalents. Please, I hope audience you are able to hear it. The other financial asset note states cash and cash equivalents, trade receivables, investment in term deposits, and other financial assets except derivative financial instrument, consignment receivable, trade payables, consignment tables. So this is in respect of financial liabilities and other financial
Hmm.
liabilities except derivative financial instruments have fair values that approximate to the carrying amounts
Hmm.
due to their short-term nature.
Hmm.
So Ind AS clearly mandates you to disclose for that is what NFRA's advisory is on. That you have to designate it
Got
to
your
a
point.
particular class of asset. First, you have
Hmm.
to decide. So this company has been excellent in designating it that these are my cash and cash equivalents, and
Hmm.
these are my other financial assets. You can't treat all the universe into other financial assets, right? You have your
Hmm.
investments, you have your trade receivables, you have your loans, you have your other
Hmm.
things,
Hmm. Hmm.
and this is what is designated upon initial recognition, and this is what is mandatory. So,
Hmm.
this being a company which is listed on global stock exchange was
Hmm.
complying to IFRS 9, and that is what India also expects us to comply to, right?
Hmm.
So,
Hmm.
I hope this is very clear. This change should come in each class of the you know company which we are annual reports which we are discussing it today. I move on the next point, Kuldeep ji. Right.
Hmm.
Okay. So, so somebody who has attended our session, let's see whether he or she can recall this well. What is wrong with this note? And in meantime, Rahul,
Yes, sir.
can you take Aarti's question again so that
Sure, sir.
Hmm.
Sure.
Hmm.
In case of lending entity, if the lender acquires or repossesses an asset from the borrower in settlement of the claim receivable from the customer, where the same should be disclosed in financial statement, and accounting of such assets will follow which Ind AS.
Okay, so there is a claim against which an asset is acquired, correct?
Hmm.
Correct. So the asset now belongs to this NBFC.
Hmm.
That's what, and a claim it is out of a settlement of claim,
Hmm.
correct?
Hmm.
Asset is acquired, right? Or asset is disposed of.
It is acquired. Like I have lent you something. You are not able to pay. Then I am taking your asset in my possession, or you are handing over. Like I have given you a car loan, and the car is being taken over by the bank or
Repossessed,
NBFC,
repossessed. Okay.
repossessed.
Kuldeep ji, you have any primary view?
Sir, primary view that I am not. I'll not comment on the presentation which is required to be done
Hmm.
from the perspective of Ind AS. But I think when you talk about NBFC or banking sector, you need to see RBI's guidelines also, and I think there is specific guideline on accounting of repossessed or collateral
Repossessed.
assets. Yes, yes, it is given by the RBI. But in my
Hmm.
opinion, when you talk about Ind AS, 32 and 109 will be applicable according to me. But I'm not
Okay.
very sure that whether it is to be shown. But we can get back to this question or about the treatment or where it is to be shown after the
Hmm.
session, because I cannot go by the plain reading of Ind AS. I need to see the RBI guidelines also.
So one what is the applicability of Ind AS 16 if will it, because this assets become my asset, right?
Hmm.
And it becomes a part of my PPE. So should it be disclosed there in accordance with Ind AS 16 is another point which I'm opening up. Uh,
Hmm.
so Aarti, one thing, right? Uh, to my belief, this now becomes your asset also. So
Hmm.
what RBI mandate is with regard to repossessed assets is one. What
Hmm.
uh, India 16 mandates with regard to taking it and putting up a footnote of the value of the repossessed asset is point number two. And if there is any other applicability of RBI circular, that's something which we have to go into detail. Hope this in principle solves your purpose. Else, if certain things are left out, right, we can get back on it. Once you mail it to Rahul or any one of us, we will have a detailed reference. But RBI mandate also needs to be seen into this. I am with Kuldeep ji. Next is what is wrong with this note is what we were discussing.
Sir, we have answers
Rahul?
for this. Yes, sir, we have
Okay.
answers. Raghavendra has given litigation details to be mentioned in detail,
Okay.
and Ankit Kumar Agarwal has asked one question related to the financial instrument equity
Okay, we will take this
investment.
question. We will take this question once we finish this note. Ankit will come back.
Okay. Okay. Okay, sir. So only one answer was there.
So Raghavendra, I think you have perfectly answered. Right. It is Kuldeep ji, please go ahead.
So I think this is something which we are deliberating since I think last 1 or 2 years. So when the changes was brought into the Schedule 3, so the intent of Schedule 3 by putting up these changes was to disclose the exact reason why it is why the asset is not being held in the name of company, why the title is not being transferred to the name of company. There may be n number of issues. One such issue can be a litigation which is being disclosed by this particular company in their case. One issue maybe there is no litigation, but the government related process which is going on. I think Ankit ji have shown the right note. One other issue may be kind of some amalgamation or merger or demerger which has taken place, and in that case the title has not been transferred. To all these questions or all these situations, I would like to sum it up in 2 points. If it is coming out of a litigation, then there is a specific requirement of guidance note issued by the Institute of Chartered Accountants of India. It says that you need to state this, state the level of litigation or the situation at which your particular dispute is. Like I think this company has mentioned that the company has filed a suit with regard to the title and is awaiting a decree. Again, one would say that it is a journal disclosure, but to that I would answer that you cannot write the whole proceedings of the case in a small column or in the note, but at least the intent is clear that they are at what stage the litigation is standing as of now. And coming on to the other point, that if it is not coming out of litigation, then in that case you need to mention the exact reason. The plot has been allotted in possession of company, the lease deed has not been executed by the lessor. It is not the exact reason, it is the present situation of the particular transaction which is in place. So there are two different situations. If it is coming out of dispute, then it is litigation. It is clear that you need to mention a very brief detail about what sort of dispute you are into and at what level it is. On the other side, you need to mention the actual reason, not the present situation. So this is what I feel by plain reading of Schedule 3.
I think perfectly answered. Let's move on the next, right? And this pertains to statement of changes in equity, right? Naturally, last time also we were able to deliberate in a shorter way. Kuldeep ji, just help us to, navigate this entire change and what has been happening in the industry while people are, going horizontally and vertically about a statement of change in equity.
So Ankit ji,
Yes, sir.
Rahul,
Sir, we have
please.
one question regarding. Sir, we have one question regarding to the previous observation title of the immovable property. Ashish Mangla
But
has
before,
asked.
right,
Sure.
right, Rahul, please. Also put up the financial instrument question after this. Rahul, we lost your voice. Kuldeep ji, are you able to hear him?
Okay.
No,
Sir,
not able to hear.
Ashish Mangla has asked, when we have large number of cases which are pending under Land Acquisition Act, how it can be put in a conciser way?
So when you are grossing up a particular class of asset and you are showing it as under this particular head that the asset is not being held in the name of company, the title is not being transferred. I have told you in my previous deliberation also that I think that the statute doesn't need or doesn't requires you to give the whole synopsis of what is going on in the courts or what is going on in the dispute. But if you have a large number of cases and the amount is material, then I think then you need to sub bifurcate, like we are showing land as one class of asset under this particular disclosure, and we are giving a amount of 1623. It may be lakhs or crores, it may be lakhs, I guess. So in case if you have certain lands which are under a certain dispute or at the same level of litigation, then you can club those particular assets in one disclosure. Then you can show again a note regarding to land. Then you can put up a value and show it at show the near about or identical reasons, because you need to do a in and out working at your end, because it is something which is internal to the company. But you need to segregate, or you need to combine different class of disputes, and based on the type of disputes or based on the level of litigation we are at or level of dispute we are at, we can disclose the same. The law doesn't needs you to give like what has happened in the past date, what is going to happen, is the one who is under dispute is being summoned by the court or not. You need to club it on the broader side. This is what I think.
The nature of the different nature of the disputes which your company is undergoing, and the amount of deeds which are the quantum of deeds in consolidation should come out. That's the intent of the law. Okay, Rahul, let's put up the financial instrument question.
Sure, sir. Ankit Kumar Agarwal has asked, equity investment elected to be valued at FVT OCI at initial recognition, where fair value either realized or unrealized to be disclosed under OCI. Once all equity is classified as FVT OCI realized, can we reclassify such amount under other equity schedule from OCI balance to retained earnings?
To retained earnings?
Yes, sir. To OCI balance to retained earning.
Can be classified such amount under the equity scheduled from OCI balances. I think, in my opinion, they can, Ankit.
They can classify. Because I did not got the question itself, but I think if you read it right, the question is that they were initially classified, right?
They were initially
As
classified at FP through OCI, either realized or unrealized to be disclosed under OCI. This is what the statute requires us to disclose. Then he is saying that once all equities classified as FP through OCI are realized, in that case, can I reclassify it under the other equity? I think I'm not very sure from the question what he is trying to say. But if it is realized and the transaction has happened, then they can reclassify it to retained earning. That is what my understanding is. Okay. Maybe some more clarity on the question is required.
Okay. Anything else, Rahul? Any other question?
Sir, one more question. Abhishek Jain has asked, sir, what if documents are not traced? Then what reason to be given?
Traced means that my question to you is whether you are in possession of that asset and you have lost the title deeds. So if the title deeds are lost, right, and the revenue records state that it is in your name, then there is no disclosure which you have to give it here, right? But if the title is not in your name and the deeds are also lost, then that is something which has to become a part to this. So I hope it answers it. If you have lost it and it is in your name, I don't think any additional disclosure is required to be given. The deeds are in your name. You have to figure out to find a duplicate copy from the revenue records. If it is not in your name and it is lost, then that fact also should come. That the title deeds are not And if you're not able to discover the status of a title deed, so there could be a third position that you have that the company has not seen whether the title deeds are actually in their name or not, right? And that situation still remains to be uncertain. Then again, this has to come under this note. And reason you have to specifically mention that you are unable to trace the title deeds or from the revenue records uh, as to whether the title is an undisputed title or not.
And one more thing, that if the amount is material or not, they need to disclose the fact that what actions they have taken to retrieve the same. Like if it is lost and it is not in the name of company, have they lost any FIR, or they are taking up with the revenue authorities or whatever it is. So I think this will make the disclosure complete in both senses.
Right. Any other question, Rahul?
No, sir.
Okay. So we move ahead. We now come on statement of change in equity, right? And Kuldeep ji, so we open this up. I told you the industry problem is that the format which is being prescribed by Ministry of Corporate Affairs, right, is not complied in most of the companies, barring one company which is majorly complying it to the spirit. And it has this entire format, the changes which are done in a particular reserves are going horizontally and vertically both. So the idea is that one, Kuldeep ji, that this has to come into only three categories, right, and the other reserves. And also, how do you cross-reference it to reserves? Now I open this up for you.
So before I start deliberating, I would like to pose this question in front of the attendees also. What they feel is wrong in this particular note, or it is not a note, it is part of the balance sheet, I guess. It is there in the specified formats which Schedule 3 is prescribed for us. So there are two disclosure in this particular note of statement of changes in equity. One is disclosing your equity share capital, and the other is other equity. So the bifurcation is, according to me, is okay. Now coming on to the first point, since we are running short of time, we have already crossed 1:15. So I would like to wait, but I would not wait seeing the time paucity. So one is equity share capital. So when you go back to the Schedule 3 or the guidance note issued by ICI, you will listen n number of time from both of us that we are referring the accounting standards or Indian accounting standard issued by the regulator or guidance note, because what we feel is that you should always benchmark law. That is what we say to everyone. So when you see the format of equity share capital, they have disclosed what is the balance as on 1st April 22, 21, 22 and 23. It is there in the format and they have shown the same. But what is missing? The point which is missing is if there are any changes on account of prior period errors or restatement of balances, then it is required to be shown under the format. So the format requires you to show prior period changes or restatement of balances if there is any changes to the equity share capital. But I think coming on to the materiality part, we can take that leverage. If there is no such transaction, we at least, to comply with the format, we should give it in under the footnote that there are no changes arising out of prior period errors or restatement of balances. Am I clear on the first part, Ankit, or you want to
Yes,
add
no,
something on
no.
this?
I think this suffice. This suffice in itself. We have some more statements of changes in equity, right? And uh, finally, I would now only want to quickly highlight the excellent reporting practices, the way this has been referred to the reserves and how concisely it is there. The idea was always to depict what amount is being transferred to retained earnings and what amount we are proposing it for dividends. So that's what is required to be disclosed. And let's not clutter this note. Let's not make it non-compliant. That's the only intent. What Kuldeep already deliberated on this. Let's move on the next point. Any questions
Sure.
pertaining to statement of changes in equity?
Sir, Jitendra Jain has mentioned number of shares are missing and nature of reserve to be disclosed, which is missing.
Right. So with this reference, I think we are now on the same page. enough of deliberation, right? Uh, okay. So this is a financial risk management note, correct? And what do you think is wrong in this note? Uh, Simple. So this pertains to foreign currency risk from financial assets and financial liabilities, right? What do you think is wrong in this note?
In terms of presentation per se or the policy, both issues.
In terms of presentation also and in terms of policy,
Hmm.
we just want you to look at the financial risk
Hmm.
management note, not the market risk part as of now.
Hmm.
Any answers, Rahul?
Not yet, sir. Sir, Jitendra Jain has mentioned forex sensitivity.
Okay. Kuldeep ji, let's open this up very quickly.
Yes, yes. Should I come on this or?
Yes, please.
So, Rahul, what is missing in this note or what is wrong in this note? Before answering this or along with the answers or along with my deliberation or what Ankit will add to this, again, there is a dilemma in the mind of the reporting teams whether they are doing it rightly or not. So, there are two specific mandates of Ind AS, I think 107. If there is any significant currency in which you have your forex operations, it is required to be disclosed. The financial liabilities and the assets are required to be disclosed, and sensitivity analysis is something which is required to be done for all the significant currencies. So I think there is slight confusion between the reporting teams or the one who is making these notes that these are two separate class of disclosures. You see when on the first page I see the analysis of foreign currency risk from financial assets and liabilities as at March 23, and above that I'm writing that these are my significant currencies like US dollar, euro, UK, pound sterling or Australian dollars, etc. But uh, okay, it is disclosed correctly if it is a significant currency to your company based on the business model or based on the transactions that you have. Coming on to the second page, the sensitivity analysis is disclosed between rupee and dollar, and claiming below the note that since US dollars is something in respect of which the company has significant exposure, the company has disclosed the sensitivity analysis. So, my friends, you are going wrong in this particular thing. If you have identified any class of any currency to be a significant currency in which you are disclosing your outstanding balances as on the end of reporting period, then the sensitivity analysis is required to be done for each and every currency. You can take excuse of materiality, say that the transactions are not material or so, but you see in this note the amounts are pending in US dollars and euro. You see 8,400 crores and 3,500 crores, 3,500 crores seem to be a decent significant figure, but yet the company has disclosed the sensitivity analysis related to US dollars only. So there are two sort of mistakes which we have discovered while reviewing the reports. Me and Ankiji, one Ankiji has mentioned me a few months back that either the companies are disclosing sensitivity analysis for one class of currency or they are disclosing the sensitivity for a composite figure like the total balance is 14,928 crores. So instead of disclosing it for different currencies, they are disclosing it for the total figure. So anything you want to add, Ankit ji, I think related to that?
I think you have perfectly answered. Only thing is two
Mhm.
things. One, we have to
Mhm.
identify which are those currencies in which the company majorly operate with.
Mhm.
Two, we have to find out, the significant currencies. Once you say that these are my significant currencies, you get into a trap of doing a sensitivity analysis of all these
Mhm.
currencies. This has been deliberated at various corporates also. And
Mhm.
uh, and the total idea is either you claim, only the two or three significant currencies and do a sensitivity of it, or
Mhm.
or you claim yourself to be, this company should have said that US dollar is the only significant currency in which they are dealing with to make it more compliant with India's requirements. So I think uh, enough of that's what we have been discussing. And you see, as a silver awardee, when we say
Mhm.
this, you see an excellent practice coming out here. So
Mhm.
this is a report, and that is why I said we have to finally look at the DNAs of outstanding report, and you
Mhm.
find such kind of references right there, right? So you can see the difference what Kuldeep ji was talking about
Mhm.
and what has now come out. Uh, okay, Kuldeep ji, let's look into 115 very
Mhm.
quickly, all right?
This is very
And
interesting.
yesterday only we were,
Mhm.
discussing this with
Mhm.
some company also.
Mhm.
There are two. So what is wrong in this note?
Mhm. I think at least we should wait for the answers for this particular note, because this is something which is very interesting, and it is like there in almost all companies, this sort of anomaly in
Right.
the disclosure.
Rahul, do we have any questions?
Yes, sir. I will ask. Sir, one.
By the time somebody answers what is
Mm.
wrong in this note, right?
Yes, sir.
Let's look into the questions.
Uh, Anushka has asked related to investment in equity share, which is classified as financial instrument at FV through OCI. Example, upon fair valuation of the investment, the change of fair value is recognized under OCI in quarter one, and in subsequent period, if there is change in value of fair value due to exchange rate conversion, where can we show such fluctuation on fair value in other equity? Can we add a line exchange fluctuation in other equity instrument under equity instrument through OCI?
I think the footnote will suffice.
Mm.
So that's all. The disclosure requirement, there's no specific disclosure requirement pertaining to a foreign exchange fluctuation which pertains to a financial instrument. But we have discussed both things, right? One,
Mm.
what is the maximum exposure a company can have
Mm.
while, if
Mm.
there's a currency fluctuation, that's only which is
Mm.
expected to be given with a sensitivity. So a footnote will
Mm.
suffice, Anushka, for these
Mm.
purposes. So you are
Mm.
you are spot on here. Uh,
Mm.
this solves the purpose. Any other question, Rahul?
Yes, sir. Surya Teja has asked, as per Schedule 3, format of other equity in statement of changes in equity, many columns are nil. Whether to show all the columns as per format?
So that's what I think Kuldeep was actually referring
Mm.
to, right?
Mm.
Forget. Teja, what's the name, Rahul?
Surya,
Surya Teja.
Surya.
Surya ji. Forget. Even if it has some figures to it, right?
Mm.
Whether the format of schedule, format of Ministry of Corporate Affairs is adhered or not, that's something which we have to look into in principle. So if it is a nil format, there is no requirement to show. I told you the intent of this entire note, when you look at the background, is what is the quantum we are transferring it to proposed dividends and what is the quantum you are having in reserve, uh, you are retaining, and the change in those three reserves, which Kuldeep already had a deliberation. Rest all should not come, should come as a part of other reserves, and the other reserves needs to be referred to.
There was one comment from Mr. Deepak from Sonata Software that he has said, my suggestion would be to display what is best practice as well as along with discussing what is going incorrect. I think Deepak ji, you have missed it. We are showing the slides in the same way. The one which is incorrect, then what is a relatively better practice, and what is according to us the nearest best practice.
So the entire presentation flow is this only, right?
Hmm, hmm,
Hopefully, when you look at the previous slide, where this company only talks about gross discounts, right? I did not purposefully show this because this company does not have a sales return policy. So I put up this
hmm,
slide
hmm.
asking because they have a sales return policy. Now the to you is what is wrong into this, Deepak ji? What do you think is wrong? And then we tell the correct practice, right?
Hmm, hmm.
Sir, we have one answer.
Right.
Rinku Agarwal has given the answer. In AS 115, contract assets and contract liabilities should also be part of this note.
So one, I think you have put up another problem, Rinku,
Hmm,
is the
hmm,
balances of contract assets and contract liabilities. Yes,
hmm,
it should be a part to this note. You are
hmm, hmm,
absolutely correct. And contract balances are not shown by a lot of companies in light of materiality, or
hmm,
sometimes they are inadvertently missed. So, what is the
hmm,
quantum of contract balances you hold? This has to come out, this has to stand out. Even I and Kuldeep suggest to all the companies that, irrespective of the materiality, this is a mandate of Ind AS, and you have to
hmm,
put up a policy also, policy of
hmm,
the contract
hmm.
balances. Any other problem, Rinku and other people, if you see in this entire note?
Sir, no other answer.
Okay, Kuldeep ji, let's open this up.
Hmm, hmm.
What is wrong into it? That's how a
So the
discount, rebate, incentive, sales
hmm,
return,
hmm,
credits, reversals should be shown.
hmm. So I'll not agree to what you have said. This is not the way it is to be shown. What is wrong in this note is you go back to 115, you go back to para 126 AA. You will see this anomaly in almost 95 to 99% of the annual reports or disclosures. This may be on account of the excuse or the reason that there is something which is as per business secrets or trade secret. I'm not able to disclose, or I'm not willing to disclose. This is a conscious call from the management side. But when you see the Ind AS, the requirement is very, very clear. It is very clear that in all cases you need to disclose this reconciliation of your revenue, that is the gross revenue, from what is your revenue from operations, which is shown in the profit and loss account. So coming on to the adjustments that are required to be shown, the company has shown discounts, rebates, incentives, sales return, credits, and reversals. So there are two type of disclosures which are required as per this particular paragraph. One is qualitative disclosure, which says that the kind of adjustment, be it a discount, rebate, incentive, sales return, credits, or whatever it is, you need to disclose the type of adjustment that you are showing in your contract balances or the contract revenue as per the contracts with customers. Then the second is you need to disclose this adjustment for each class of adjustment. So I understand the discounts, rebates, and incentive cannot be of same class. And sales return, some of the companies are doing sales returns, discounts, rebates, schemes, etc. So an incentive is something different from discount. It may be in a scheme. If you see any FMCG company or any company which are operating into retail space, you and me, everyone goes to shopping and we see end of season sale or the discounts which are there in the market as of now on the winter season. So this is not discount or this is not rebate. It is a scheme. So it is a separate class of adjustment which is required to be shown. A discount is something different. A scheme is something different. A sales return is something different. So intent of the statute is to show each and every adjustment along with the qualitative data, but with one exception. If you say that there is an exception because of the business trade secret, Ankit ji, I would like to ask this from you, that ठीक I am giving it on a broader side, stating like discount separate, scheme separate, sales return separate, and I am giving a broader qualitative data below that discounts of this nature. I'm not asking the companies to disclose the rate of discount or the policy of scheme, but can on account of the exception of business or trade secret, they skip this. Can they skip this disclosure, or if they are making a broader disclosure, do they need to put this fact also that it is on account of the business secrets or the trade secret, the company is not disclosing the same? What is your view
So
on this?
I think such note where we claim that it is a trade secret, as a stakeholder, as the reader of this financial statement, I don't have that kind of a comfort. While somebody, it might be a trade secret, but should not come on the face of the footnote. You rightly pointed, what is the point of showing this reconciliation? Why Ind AS 115 asked for this reconciliation? Because it wants its users to know as to what is the quantum of benefit on each category, and the sales return or a credit or a reversal for all these figures to come out with respect to what is the impact on the revenue. Else, barely stating this doesn't solve the purpose unless you are able to depict uh, uh, depict a reconciliation. So you give this or not, it is fine then. Eventually, whatever your figure is fine. So that's the only idea. So my point is not to disclose such thing that it is a trade secret or something, but to quantify to the maximum permissible extent for making sure that Ind AS 115 is completely complied to. Okay.
Do we have any best
That-
practice in this, or I think almost all showing it on their own?
No company. That's what I said in the beginning of the session, that there might be cases, and answering to what Deepak ji was also saying, that we did not scrolling through more than 1,000 reports. We did not found this practice. The most reasonable practice was this only, and importantly, to show this reconciliation is in the spirit is what we are expecting to deliberate on. Okay, now we come on one last. Then we'll take the non-financial thing, or we might take one or two more in gas. So again, it is an excellent practice. Lot of companies, I think, one, they fail to show these ratios which are being specifically provided in the guidance notes, right? All these ratios. Yesterday only I was discussing with the company, they were not able to show the current ratio. Forget all these ratios. The current ratio was missing from a manufacturing company. So one, the definitions of these ratios, along with the change, and if there's a variation, right, for more than 25%, there has to be a reason which needs to be attached to it, right? This reason should come out specifically. We see SEBI slapping huge penalties for non-disclosure of these reasons, and that is why an excellent practice has come to you, right? So hopefully your ratios are also depicted this. Lot of companies depict the ratio, fails to depict the variation. Lot of companies fail to depict the variation, but do not take care of the 25% variation clause what SEBI has mandated. Hopefully this solves the purpose, right? This
One
we
more
already
thing.
had.
One
Kuldeep ji,
one
please.
one more thing. The kind of debate or the discussions we both had in our few previous meetings or in past few months, the debate about what is a positive affirmation and what is the statute's requirement. So if you deliberate on particular Indian accounting standards or the requirement of guidance note or schedule 3, someone would come and say that it is not written in the statute anywhere that you need to show or you need to give a positive affirmation. But when you see why we have included this other statutory information note, you will see, I'll not say 7, 8 out of 10, but you will see 4, 5 out of 10 annual reports in which you will see that this particular figure is missing. The reason why it is missing, companies would say that if I don't have any Benami related transaction, if I don't have any such dispute going on me, or if I don't hold any cryptocurrency or virtual currency, it becomes a positive affirmation which I am being asked to give. But my friends, it is not that case. It is a clear-cut requirement of Schedule 3, which say that you need to give other statutory information, additional regulatory information, and the pointers are already specified in the guidance note also. So it is not a positive affirmation, it is a statute-based requirement. So if you are not saying that you don't have any transaction, I might assume that you are having or you are not disclosing. That was my point in this particular.
Kuldeep ji, I'll sum this up because we'll sum the financial part
Yes, sir.
now.
Yes,
I'll
yes.
take
Mhm,
few
mhm.
portions of ESG.
We
Integrated
should.
has been discussed in the last session.
Mhm,
So that is why I'm
mhm,
not putting up the integrated reporting thing today. Right?
mhm,
It's a conscious
mhm,
call that, last we had Rahul, we had more than 2 hours discussion only on integrated
Yes.
side of the report, and that is why we started with financial. What Kuldeep ji says is a very important thing. Now,
mhm,
when I say, and I am picking a few index where I give a positive affirmations, right? For
mhm,
example, Kuldeep ji, in inventory, right?
mhm,
Lot of companies give a positive affirmation that there are no inventories, correct? Which are pledged. For a
mhm,
PP index 16, we give a
mhm,
positive affirmation stating that there are no PPs which are
mhm,
pledged to a banker, right? Uh,
mhm, mhm,
or certain companies in which PP or inventories are pledged, they give it under the borrowing cost note. When you're
mhm,
doing a Ind AS 23 compliance, spot on, you have given there.
mhm,
When you're
mhm,
giving a Ind AS 2 or Ind AS 16 compliance, you failed.
mhm,
And there you
mhm,
can't refer, either you refer them to the borrowing cost note, at least make sure that
mhm,
the footnote has that whatever the carrying values of these inventories are, they are referred
mhm,
there.
mhm,
Similarly, I pick up another Ind AS 37,
mhm,
which talks
mhm,
about contingent liabilities and provisions. In Ind
mhm,
AS 37, lot of
mhm,
companies fails to give, whether there is an expected outflow arising out of a contingent liability, whether there are
mhm,
any reimbursement received. 2 3 days back, I was deliberating at you know, a listed large conglomerate. They said that this needs to be given in respect of provision. Then I took them to
mhm,
Ind AS 37. This is given.
mhm,
This needs to be given in respect of the contingent liabilities also. This is in
mhm,
compliance to the guidance note. For Ind AS 38, again a positive affirmation whether evaluation is not there or not. There or not. Again a positive affirmation whether company possesses any infinite life assets or not. All
mhm,
these positive affirmations which you are giving helps you to
mhm,
score. Simple as that.
mhm,
Now,
mhm,
if there's a disclosure requirement, that positive affirmation has to stand out. And if it
mhm,
is not standing out, then you will always feel that we are giving in light of materiality. But it is not only the materiality which needs to be taken care. Once a
mhm,
disclosure requirement of Ind AS is coming out, the disclosure needs
mhm,
to be made, right? Irrespective
mhm,
of the materiality into it. The material
mhm,
things are only disclosed when Ind AS gives you an option or Ind AS is silent about a particular matter.
mhm,
For example,
mhm,
Anushka, while putting up this question that whether I should give a footnote on
mhm,
a foreign exchange fluctuation with my financial instrument, right?
mhm,
Uh, is what is expected to be given in light of materiality, right?
mhm,
So India doesn't mandates you to give that kind of a affirmation also. That's what I am, putting up.
Hmm.
So I hope the entire scheme of financial notes, because so for each note we will have 10, 15 points, but broadly we wanted to come out loud and
Hmm.
say that these
Hmm.
are DNAs of excellent reports. When you look
Hmm.
into it, you realize that institute is not blatantly going wrong in selecting a company for an award or not selecting a company. It is your perception of the institution, that why my report is not selected, or why somebody else's report is selected. So
Hmm.
idea was, let's deep dive into it and figure out how does an excellent practice looks like. If your
Hmm.
ratio analysis looks like this, it's an
Hmm.
outstanding report. Maybe not,
Hmm.
maybe you get eligible for what you are aiming at.
Hmm.
Also, please don't only look after the excellent practices. What do we do of the regulator if tomorrow SEBI comes, if tomorrow
Hmm.
NFRA comes? And that's I discussed on the last session also. Sometimes
Hmm.
institute fears. Sometimes we feel a report is excellent, but
Hmm.
in a particular excellent report, a
Hmm.
mistake like a wrong nomenclature which we were discussing at the beginning of the session only, right?
Hmm.
Could probably refrain institute to award such kind of a report. That's from the financial side. I, Kuldeepji, will take 10 more minutes,
Hmm.
right?
Yes, sure. Hmm.
And will deliberate on two, three things, right? The
Hmm.
non-financial things.
Hmm.
And this is a silver awardee, excellent practice. Now, your practice is what you know. I don't want to show too many substandard practices, because eventually then we start questioning ourselves, but want to put up one thing. So, in last 5, 6 years, you will realize institute have stopped giving gold awards only.
Hmm.
There is a one or two companies institute gives a gold award. And the
Hmm.
logic for this is that I think, irrespective of so many constant efforts, right, the reporting practices are not changing. And when institute goes at a global forum, so your gold award or your platinum award, right,
Hmm.
eventually is moved to SAFA, is eventually moved to the International Research Awards. And when it goes there, then you see Indian companies not getting any awards. So institute might be
Hmm.
biased. That's what lot of people sitting here thinks, that institute is biased, but then a jury at an international level is not biased. The problem is
Hmm.
with the reporting structures. So
Hmm.
from this background, I talk about the risk management framework, and that is why institute gives a lot of thrust on the companies who benchmark their risk management frameworks in a way where either they are benchmarked it to a global framework, be it a ERM 2017 framework, be it a COSO, be it a GRC, but that, as a part of your framework, this should come out which framework you are benchmarking. Second,
Hmm.
how much it is in alignment to your risk management policy.
Hmm.
So, Kuldeep ji, I found a company where risk management
Hmm.
policy was benchmarked to some other framework, and they are
Hmm.
claiming themselves to be, benchmarked to 2017 framework. So
Hmm.
that's another problem. Third, people don't categorize the risk based on the risk which their industry attracts, right? So this might not be a relevant risk for you.
Hmm.
A risk of, available of competent human resource could be a risk
Hmm.
for a IT company who is having a
Hmm.
offshore operations, and
Hmm.
could not be for a company, a manufacturing company who is more in requirement of, a unskilled or a semi-skilled labor. A cyber
Hmm.
risk or a digital, this is a media company. This might have, the digital transformation risk. So
Hmm.
these risks and the process should come out. The
Hmm.
process of, your audit committees, your internal controls, the adequacy of internal control. Just merely saying that we have an internal control system, an internal audit system, they are statements in the annual report. Yes, you are complying
Hmm.
to what MDA's regulation is, what SEBI LODR wants you to speak on. But how are you interacting how are you gaining the conviction of the stakeholder is important. Also, not only in risk, even in opportunities. We always say this to our, to our audience also, to the clients also, that you have to talk about the mitigation plans. If there is a risk, what is your plan? If there's an opportunity, what is the plan? Kuldeep ji, I have not displayed a, an annual report in which in opportunities they were talking about risk.
Risk, vice versa.
So, and vice versa. So I think we have to customize all these sections of report to make it an outstanding report. The next is this is an excellent depiction of, I am putting up a silver awardee report only. Excellent depiction of your board's cumulative experience. And this was also not discussed last time, right? The cumulative experiences of your board, the areas of expertise, the memberships of other listed companies, all these things gets eventually investors' attention and the stakeholders' attention, right? So hopefully just, merely writing names of your board members or their entire detailed CVs. Now the visual aids also carry lot of marks in eyes of institute. So it is, as of now, what Kuldeep ji was deliberating was on law, even to that extent. But those companies who are, good at complying to laws are not able to create a better visual aid for it. And that's what, we'll discuss in the next slide also. So we discussed the integrated approach, and in next 5 minutes, we will wrap this up. But I wanted to, quickly come on 2-3 things. One, Kuldeep ji, once you disclose your ESG, right? So last we had a discussion on an integrated report. Today, let's discuss, what an ESG matrix is, and what are the differences. We had a lot of deliberation. Question number one: when you are preparing a BRSR report, is it necessary to give a ESG highlight in your annual report? Rahul, please look for an answer. My question is, when you are preparing a BRSR report, is it necessary to have a ESG highlight? And Rahul, do we have any questions? Because then we'll be wrapping this up.
No, sir. No, sir.
So companies, now the problem, Kuldeep ji, which I am coming out, these reports have gone into 500, 600 pages now, right? And this is because of 3 very important sections. One, the ESG section, other, the integrated reporting section, and the third is a highlight of the integrated and ESG section into the annual report also. So, should you have a ESG highlight?
I don't think so, in my opinion.
So, ideally, you will not. If you are having a BRSR report, the highlight should be, if you have to talk about this, Hena, why I put this. Now, people, while preparing their ESG reports, talk about environmental capital, social capital, and governance capital. These are not capitals. These are not capitals, right? So the capital comes from the capital approach model, which integrated reporting is giving you. So my learning attendees some attendees have got confused, and I received a lot of queries after the integrated reporting. Ki wo jo capital you are saying, we also show this environmental capital, we also show the social capital. No, that comes out from the capital approach of integrated reporting, which you can see on this slide, that these are those capitals which are expected to be shown. The 6 capital model which we discussed last time. Now, few things for ESG reporting, right? Once you start reporting, if you are reporting a ESG highlight, then I think your intent is to report the integrated reporting. Better you start preparing an integrated report. So all with the effort which you are preparing your ESG highlight, your entire integrated reporting will be prepared. So once you start depicting this, once you have thought that this is a capital approach model, then go for an integrated reporting. Two, I was looking at the governance of ESG, and that's where my concern is. क्योंकि the problem is अभी तक तो इन्होंने बनाई है. As of now, you have only prepared it. Now you have to get it attested. So how many of the companies have got their BRSR report certified in last year, because the mandate comes from this year? But a lot of companies, the bigger companies, have got a certification over it also, and bigger auditors were able to convince them also for that kind of a certification. But my point is that now it comes from a mandate that you have to get this certified. And now my question is the governance structure. So whether when you are reporting a ESG, whether you have a ESG committee attached to it, nobody talks about it. Nobody is talking about their ESG committees. Nobody is talking about the terms and references of this ESG committee. Nobody is talking about the governing structure of these ESG committees. And these are common problems with ESG reporting. So once you start reporting the governance structure, you have to talk about the board compositions. You have to talk about, the gender diversification of your board, not of your employee. When you talk about your social and relationship capital, right? That's where you talk about the gender diversity of employees. So all in all, this ESG framework, if you are even coming up with a highlight, suggestion one, integrate it to the integrated reporting structure, like this company has done. This is an excellent reporting practice. Second step is you have to determine the materiality, right? Now look at the stakeholder engagement here and look at the materiality here, right? This materiality matrix needs to be in alignment with the IFRS S2 standard. There is a standard which is already mandated. There are two standards on sustainability. Please check on this fact, how much your report is in alignment with IFRS S1 and S2 standard. Now look at how you are identifying a stakeholder and look at the type of engagement you are trying to write. So this is absolutely going wrong. So you have to come out with the key stakeholder groups, and based on these key stakeholder groups, the materiality assessment needs to be done in compliance with TCFD, in compliance with IRC framework. And another problem, so people are preparing two metrics. One, the ESG materiality matrix, other, the integrated reporting matrix. There is only one matrix which is expected to be prepared. That is this matrix, which is in compliance with both IIRC also and both in compliance with the TCFD. Another problem with ESG, when you are saying that you are going towards ESG, then the journey of decarbonization is not standing out anywhere. So that's the biggest environmental impact which somebody has to disclose, is the journey of decarbonization. How are you capturing your air emissions? How are you showing it comparatively? How are you capturing your GIG emissions?
GSC.
All these things are missing as a part of an ESG reporting. My point is, ideally, an ESG reporting talks about those three annexures and everybody might be fulfilling the formats of it. It is the approach of your company towards that ESG which makes you stand out, right? This company is able to, and this company was a Gold Award winner for Sustainability Award, right? Was able to depict the correlationships between 6 capitals, the ESG framework under the integrated reporting framework, making sure that it is compliant to the IIRC also and the SASB framework also, making sure that the governing structures are coming out, the board structures are coming out, the terms of references of ESG committees are coming out. All these things are DNAs of an excellent ESG reporting. So my point here will be, I think let's go back, revisit our annual reports. I think this season we not only want Institute to give more and more gold awards, we want our companies to go and win at SAFA, at international research awards and making sure that uh, you know we are most compliant reports. This is not only as I started this session, Kuldeep ji, last time when I took, this is not a branding document, boss. This is
Mm,
this is this is a statutory document. 90% of this document comes out of statute, and there is
mm,
only 10% to play upon. In that visual aids, graphics,
mm,
fancy depictions, please don't miss what law has to say about a particular section. And as chartered accountants, the biggest mistake which we do is that statutorily we see a lot of things where the financial statements are talked about. Non-financially, since either it is not a part of the department or it comes from the IR side,
mm,
that's where also, now you are certifying a lot of things. So please look into look all the minutest aspects of your annual report. When I and Kuldeep looks at an annual report, we have a three-tier system. So he will look, then I will look, then he will look. That's the kind of system we try to maintain when we review any annual report, even from institute's perspective, so that there could be a possibility that whatever the perspective he has built, I might not have built that. Requesting
mm,
you to please be more compliant with your annual reports. Make sure that whatever we have discussed, I am again saying, repeating it, it was not a practice, a bad practice or a good practice which I wanted to highlight, or
mm,
a company having a inferior practice or a superior practice. It is a
mm,
standard industry practice. I might have picked any
mm,
one company's annexure. Unless it
mm,
was found in 5, 7, 10 companies, we have not put up a annexure only. So please don't take anything personally, but the idea was always to give you a practical expedient of how should an
mm,
annual report look like. Uh, I am sincerely thankful to Rahul, Neha, the entire research committee staff, chairman, vice chairman of the research committee, and my special thanks to Secretary Dr. Amit Kumar Agarwal ji, and over to Kuldeep ji to give a final thought. Please put up your questions on mail now, and we
mm,
will take these questions on mail. You can mail to research committee. You can mail to us directly.
mm.
LinkedIn, whatever it's easy to find people if you want to. Right. Thank you so much.
Thank you. Thank you, Ankit, for your wonderful deliberation. I would not take much time because we have a hard stop at 2. We have already crossed the mark because there is another meeting which is going to happen in this meeting room that was informed to me. So, to sum it up from where you have left about non-financial reporting, one small thing that ESG reporting or non-financial reporting is not always about depicting wonderful graphics or having a great visual aid in the annual report. It is all backed by the statute. And recently, SEBI has also said that BRSR is not about complying with the format, it is complying with the letter and spirit of the statute, which is being prescribed by the regulator itself. So, with core value framework being notified in this year, with leadership indicators related to value chain disclosures of, value chain partners, environmental disclosure related to value chain partners being to be disclosed on explain or comply basis. I think the non-financial part or the ESG part embedded into BRSR and integrated reporting will play a pivotal part in presenting an excellent or outstanding annual report. With these words, I thank all the research committee officials along with the chairman, vice chairman, and secretary Amit sir, and the team Neha, Rahul, and other people sitting here for making this happen in a very short span of time. Over to you, Rahul, for the concluding remarks, and then we'll take your leave.
Thank you, sir, for the insights and such a wonderful session. On behalf of the research committee, I would like to extend my warm gratitude to our esteemed chairman and vice chairman of the committee, CA Dr. Anuj Goyal sir and CA Kotha S. Srinivas sir. I would like to place my deep gratitude towards both the speakers for sharing their wisdom and spending their valuable time throughout on the various topics of the annual reports. The journey of learning keeps going on. Wish you all a happy learning. I hope you all had a great session. Thanks.
Thank you.